Hi there, Brian here from the Cash Flow Desk. Today, we're clearing up one of the most common questions. What's the difference between a controller and an accountant? If you're growing your business and trying to figure out what kind of financial help you need, or if you're just curious about who does what in the finance world, this breakdown is going to be really useful. We'll cover what each role actually does, when you might need one versus the other, and how they work together to keep your finances running smoothly. Let's start with accountants, since that's probably the role most people are familiar with. Accountants handle the day-to-day financial record keeping. They're the ones making sure transactions get recorded properly, invoices get sent out, bills get paid, and your books stay current. Think of them as the foundation of your financial operations. They're tracking income and expenses, reconciling bank accounts, managing accounts payable and receivable, and preparing basic financial reports. For a lot of small businesses, an accountant might also handle payroll, sales tax filings, and getting documents ready for your CPA at tax time. The work is detailed and systematic. A good accountant keeps everything organized and accurate, so you always know where your money is going and coming from. Now, a controller operates at a higher level. While accountants focus on recording what happened, controllers are more about analyzing what it means and planning what comes next. Controllers typically oversee the accounting team and the entire financial reporting process. They're responsible for monthly and quarterly financial statements, budget preparation, and making sure everything complies with accounting standards like GAAP. But here's where it gets interesting. Controllers also dive into financial analysis. They're looking at trends, identifying problems before they become serious, and providing insights that help leadership make better decisions. For example, if a SaaS company's customer acquisition costs are creeping up, the controller would be the one to spot that trend, analyze why it's happening, and present options for addressing it. The biggest difference comes down to scope and perspective. Accountants are focused on accuracy and compliance. They want to make sure every transaction is recorded correctly and all the numbers add up. It's detailed, methodical work that keeps your financial foundation solid. Controllers take that accurate data and turn it into actionable insights. They're looking at the big picture, cash flow trends, profitability by product line, budget variances, things like that. Another way to think about it, accountants tell you what happened, while controllers help you understand what it means and what you should do about it. In terms of decision-making, accountants typically handle routine financial processes, while controllers are involved in strategic planning and policy decisions. So when does it make sense to bring on each role? Most businesses start with accounting support, either an in-house accountant or an outsourced bookkeeping service. You need this foundation from day one to track revenue, manage expenses, and stay compliant. Controllers usually come into play as you scale. If you're doing a few million in revenue, have multiple product lines, or are planning to raise capital, that's when controller-level oversight starts adding real value. Here's a practical example. A growing e-commerce business might start with a part-time bookkeeper handling transactions and basic reports. But as they expand into new markets and need better inventory management and profitability analysis, they'd benefit from bringing in a controller to provide that strategic oversight. Some businesses skip the full-time controller route and work with fractional controllers who provide that higher-level analysis on a part-time basis. In larger organizations, accountants and controllers work as a team. The accounting team handles data entry, transaction processing, and routine reporting. The controller reviews their work, ensures accuracy, and uses that clean data to create management reports and financial analysis. It's a natural division of labor. Accountants make sure the numbers are right, and controllers make sure the business understands what those numbers mean. For example, in a services business, accountants might track project costs and client billing, while the controller analyzes project profitability and identifies which types of engagements are most profitable. This teamwork approach means you get both accuracy in your day-to-day records and strategic insights for planning and decision-making. Here's the bottom line for your business. If you're just getting started or running a straightforward operation, focus on getting solid accounting support first. You need that foundation before anything else makes sense. As you grow and your financial picture gets more complex, multiple revenue streams, inventory management, investor reporting, that's when controller-level expertise becomes valuable. The key is matching the role to your actual needs. Don't hire a controller to do bookkeeping, and don't expect a bookkeeper to provide strategic financial analysis. Both roles are essential, but they serve different purposes in keeping your business financially healthy and growing. If this helped clarify things, hit like and subscribe. And let me know in the comments what other finance roles you'd like me to break down. Thanks for watching. I'm Brian, and I'll see you in the next one.